Welcome to the Explainer. Today, we're tackling something that is honestly incredibly frustrating, but way too common for successful business owners. We're going to look at exactly how you can unlock capital that's literally trapped in your assets when traditional banks just slam their doors in your face. We'll do this by breaking down a real-world case study step by step, showing you how strategic alternative lending actually works.
Okay, let's dive into this. Have you ever been rejected by a bank despite having a thriving, super profitable business? Look, if you're a self-employed Australian, you're probably nodding your head right now. It's a massive roadblock. Think about the sheer frustration of it. You've got these grand expansion plans mapped out, and you own property that's sitting on an absolute goldmine of equity. But when you walk into the bank to access that capital, boom, automatic rejection. It's incredibly discouraging to know your business is succeeding, you have the numbers to prove it, yet you can't get the financial backing to take it to the next level simply because of bureaucratic red tape. Section 1. The anatomy of a no, or what we can call the complexity problem. Let's look at our case study. We've got a highly driven entrepreneur who had been trading successfully for 5 years. They had the drive, the vision, and they desperately needed expansion capital to scale up. But when they approached their current everyday bank, their application completely stalled out. Now, what's really interesting about this slide is exactly why it stalled. Just look at this web of entities. It's a complex structure, a total of 6 different companies. You've got 4 non-trading or dormant ones, a brand new company that's only been trading for 6 months, and then there's that primary entity with the solid 5-year track record. To you, or really any savvy business owner, this just looks like standard asset protection or structural evolution, right? But to a traditional bank's automated risk algorithm, this complexity is a massive red flag. They see multiple entities, they see risk, and they just see a massive headache. And that brings us to the core issue. As the source material notes, the bank rejected them because their, quote, paperwork doesn't fit neatly into their standard boxes. You see, along with that complex company structure, there was a timing issue. The client's accountant hadn't actually prepared the financials for the previous financial year yet. Traditional banks rely heavily, like almost exclusively, on perfectly straightforward structures and up-to-the-minute tax returns. Without those finalized documents, the bank system literally cannot compute the loan. It's just a rigid, robotic process. It becomes an automatic, non-negotiable no. Section 2. Working smarter, not harder. The low doc strategy. This is where we shift the narrative from frustration to strategy. Our client wasn't a bad risk. In fact, they had a very strong primary business and substantial real estate equity. They didn't need to fundamentally change their business operations. They just needed a specialist who actually understood self-employed setups. And that specialist approach comes down to alternative documentation, often referred to as a low-doc loan. As you can see, this is a lending approach that completely bypasses all that traditional red tape. It doesn't rely solely on standard tax returns. That means you don't have to put your entire business growth on hold, waiting months for your accountant to finalize the previous year's financials. It solves the exact problem of missing paperwork by looking at the health of the business through a much more practical, real-world lens. Section 3. The magic key, the accountant's debtor. So if we aren't using stacks of tax returns, what are we using? Well, there is a remarkably simple strategy that completely circumvents all those usual banking hurdles. And this brilliantly illustrates this stark contrast we're talking about. On one side, we have the traditional bank's demands, exhaustive mountains of bank statements, business activity statements, and perfectly finalized tax returns. Honestly, it's exhausting just trying to gather it all up. But then, look at the low-doc approach. 0 financial statements required. No way, right? Instead, the magic key is simply a verified accountant's letter. Just one formal letter from the client's accountant that officially confirms their income and their ability to service the loan. That is the massive difference between bureaucratic exhaustion and streamlined efficiency. Section 4. Unlocking the reward. Now that the strategy is set and the magic key is in hand, let's dive into how this alternative lending approach actually played out for our entrepreneur. Let's move to and see how this builds step by step, transforming a totally stalled plan into reality. Step 1, they use that verified accounts letter to instantly bypass the traditional red tape. No waiting around for perfectly packaged taxes. Step 2, they didn't just get new money. They took the opportunity to refinance and streamline their existing business debt, making their ongoing monthly cash flow far more efficient. And finally, step 3, they successfully cashed out the trapped equity in their property specifically to fund their expansion. They consolidated, optimized, and extracted capital all in one smooth motion. And the result of those 3 steps? $500,000. Seriously, instead of pausing their growth for an entire year just to fit into a traditional bank's standard little box, they successfully unlocked $500,000 to inject directly into their business. They're now scaling exactly as they had originally planned. It's a massive win, born entirely out of knowing how to pivot after an initial rejection.
So, the absolutely crucial point I want you to take away from this explainer is simply this: find the yes when the banks say no. If you're a business owner and you have equity in real property, you absolutely do not have to let a traditional bank's automated rejection stop your wealth growth. There are alternate pathways and specialized lenders whose entire purpose is to look at your actual potential, your real assets, and your capacity to grow, rather than just perfectly matching up paperwork. Which leaves us with this final, incredibly important question. Could your equity be working harder for you? Are you sitting on resources right now that you assume are just locked away simply because a traditional lender didn't understand your business structure? I highly encourage you to rethink your lending strategies, explore alternative documentation, and make sure you aren't leaving your hard-earned equity on the table. Thank you so much for joining me for this explainer, and I'll see you next time.